Alrighty. Good afternoon, everyone, and welcome. I am Jessica McClellan, the Practice Growth Manager at William Vaughan Company. We really appreciate you joining us today. I'd like to take a moment and thank Jolene and FEI for having us. We really find great value in being a part of this organization and appreciate the opportunity to share with your membership insights on this significant topic. Before we jump in, a few housekeeping items. During the presentation, we ask that you remain in listen-only mode and you keep your cameras off to reduce interruption. There will be a question and answer session following the end of the presentation. You can go ahead and submit your questions in the group chat, which is found at the bottom of your screen. So go ahead and submit those questions there. And click submit. We will attempt to get through every question that we can. And we will also be providing a recording of today's session in addition to a link to our PPP loan calculator. So with that, let's begin. As government lockdowns are being lifted across the country, business owners are shifting their focus to the restart of their operations. Understanding and maximizing PPP loan forgiveness and having the right tools to plan your recovery are top of mind. With that, we wanted to share with you some of the latest guidance, provide you best practices, and answer some of the most common questions to help you navigate these complex waters. With us today, we have a stellar panel. We have Kate Matt, a WVC partner and the firm's advisory service practice leader. We have Mike Hamp, a partner in our tax department. And we also have Michelle Clement, who is a partner as well, and serves as the co-leader of the firm's tax practice. We hope you enjoy today's presentation and find the information useful. With that, I pass the floor over to Michelle.
Great, thank you, Jessica, and welcome everyone. We're very glad to have you on the webcast today. What I'm going to do is go over the big picture, generally the major phases that employers and businesses have been experiencing over the last few months. As you know, back in March, that's when our businesses were beginning to feel the shutdowns. The states, through different phases and timing, were closing down non-essential businesses and moving to remote operations if possible. Also at the end of March is when we got the CARES Act. That was passed on March 27th. So moving into April, we have employers trying to decide what relief is available. And for the majority of our mid and smaller sized businesses, it was the PPP, the Payroll Protection Program, and the loans that ended up being forgivable, which was something the businesses would find a lot of relief from. So as people began to get the applications and get their funding, we moved into May and somewhat into June here, and everyone is kind of shifting to forgiveness and compliance. So we were looking at what's it take to get fully forgiven, what are the best practices, what do I need to keep on file, how am I going to apply for forgiveness? And that's pretty much been the focus for the last several weeks and what the program today is primarily going to cover. I will add that the PPP funds are still available. The application period goes through June 30th. So if someone's out there who hasn't gotten the PPP funding, it's still available. You can apply through June 30th. As well, the SBA most recently has indicated that they have over 130 billion, just over 130 billion left to loan. So once we get through the forgiveness and we get into June and the future, businesses are looking for the restart and the recovery phase. They're going to have to rethink their business model, maybe do some adjustments there, do some forecasting, look at cash flow projections, and from a short-term, near-term, mid-term, long-term focus, get positioned to be able to operate in our new world. All right, next slide. Significant changes. Since the CARES Act was passed at the end of March, we have been getting on a regular basis, daily, weekly, periodically, various guidance and additional legislation and frequently asked questions in order for us to be able to work through the PPP application process and forgiveness. So the most recent bill we received was the Flexibility Act that was signed by the President on June 5th, last Friday, and it brought with it some very beneficial changes for the businesses who received these funds. One of the first things it did was it changed the payroll requirement from 75% down to 60%. So that would mean you would only need to spend 60% of your loan proceeds on payroll related costs and still not be subject to the potential reduction in forgiveness. One of the next things it did was change the 8-week covered period for spending the funds within which you have to expend the funds to 24 weeks, or if earlier, December 31st, 2020. So that gives us 24 whole weeks to spend that money, or by the end of this year. Additionally, it extended the deadline to restore your levels of FTEs and compensation in order to be exempt from reductions until December 31st of 20. So there are some reduction things in the bill that will be spoken about later that could cause your forgiveness to be reduced, but these safe harbors allow you to be exempt from the reduction if you can restore FTE and compensation levels to a pre-COVID state by December 31st. There was some additional exceptions implemented as well with this new bill. So you can be exempt from the FTE reduction also if you are unable to rehire an individual, or you're unable to hire similarly qualified employees, or also if you're unable to return to the same level of business activity as you were operating pre-COVID, February 15th of 2020, due to issued restrictions like from the CDC and whatnot. So you qualify for this additional safe harbor by demonstrating your good faith determination of being eligible for it, and then keeping documentation of that as well. The loan period was extended from 2-year repayment period out to 5 years. It's still a 1% interest rate. And then also, before this new legislation, somebody who got the PPP funds was not able to defer the employer's share of Social Security taxes on wages during 2020. And with this new bill, they are now able to do so. More on that later. That is all I have. So with that, I'll turn it over to Kate.
Thanks, Michelle. All right, so as Michelle noted, and if you've been following along with this, as you well know, this is a very evolving process and set of guidelines and instructions. So we'll caveat everything that we're giving you information that's current as of about 9 a.m. this morning. Anything that has changed since then, we're probably not aware of, and continue to stay tuned because we do expect some additional changes to be forthcoming. The SBA and Treasury have said that they will be issuing some new FAQs and or interim final rules, and there will be a change to the application as well. So certainly stay tuned. This will continue to change as we go. So Michelle just hit you with the kind of most recent changes, and those were some much awaited changes and really brought a lot of relief. I'm going to kind of back it up now and just talk through at a basic level, how does the calculation work and what some of the components are. I'll weave into it the various things that Michelle talked about too, but really want to kind of go through how does this whole thing kind of come together. So if you remember back to the application phase, you basically looked at 12 months. Most people use calendar of 2019, although there was another option out there, but look at 12 months of payroll You divide that out to figure out what your average monthly amount was, take that by 2.5 times, and that was the loan amount that you were eligible for. So now we've moved into the phase where you actually get to use the funds. And the great thing about PPP is that if you use the funds in these specified ways within a specified time period and meet some other rules that they've got, you can get up to all of it forgiven. So this loan essentially becomes a grant. So we'll talk through here exactly what the different components are of that. So step one of the calculation to look at forgiveness is to add up all of those costs that, or all of those expenses that you had during that covered period of time post receiving funding. So this is the dollars that you are spending of that PPP funding. Are you spending it on the eligible items that are listed out? So first thing is payroll. So you'll add up your payroll and payroll related costs. Then you're going to add in the eligible non-payroll cost. That's going to get you the total eligible cost. So this step one is all about the dollars that you actually are spending during that covered period. Step two, then, you're going to start looking at potential reductions that you might have. So first thing is payroll. So payroll divided by 60% gives you this payroll 60% requirement. As Michelle talked about, this previously was a 75% requirement, just reduced down to 60. So some more flexibility here. Basically, if you spend 60% or more of your PPP loan funds on payroll-related costs, you are eligible for full forgiveness of that loan, assuming you meet these other criteria. But that's kind of the first hoop that you've got to jump through is, did you spend at least 60% on payroll cost? Second part then of step two is to look at if you had wage reductions or FTE reductions during that covered period. And if you did, those are going to potentially reduce the amount of forgiveness that you're eligible for. So again, going back to PPP, it's the Paycheck Protection Program. The whole idea was to provide money to businesses so that they could continue to employ their workers. So really trying to fund payroll, also allowing funding for some operating or overhead expenses as well, but really to fund payroll. So because payroll was the big push, there's some extra things in there with these wage reductions and FTE reductions to consider, just more incentives to keep folks employed to the level that they were before COVID and at the same compensation that they were prior to COVID as well. So you've got those total eligible costs, subtract out wage reductions, subtract out FTE reductions. That gets you this modified potential forgiveness. Then you move into step three, and step three is a kind of 3-number comparison. So you'll look at the two amounts that you calculated in step two, that payroll 60% requirement, also that modified potential forgiveness, and then the third amount that you have to compare against is the PPP loan amount that you received. So you'll lay all of those out, and the lesser of those three, that's the amount that you're going to apply for forgiveness on. So what does this mean? Well, PPP loan amount, you're going to be limited to that. You can't have more forgiven than what you actually received. Payroll 60% requirement, again, you spend anything less than 60% of those dollars on payroll, you're going to be limited as to how much forgiveness you are eligible for. And then this modified potential forgiveness. Those are those other items that are encouraging you to maintain your level of employees and at that same compensation level. So if you've got reductions in wages or reductions in FTEs, that's also going to factor into a limitation on the forgiveness amount that you've got. So let's talk now about some of the specifics that go into each of these items. So payroll. With payroll, you have an option here to either use the standard covered period or this alternative payroll covered period. So standard covered period, it is going to begin on the day that your loan funds hit your account and go out either 8 or 24 weeks. So if you received your loan prior to 6/5, the date that that Flexibility Act was signed, you have the option of either going with that original 8-week covered period, or you can choose to use that extended 24-week covered period. So you kind of have to look at what's more beneficial for you. A lot of folks were having a difficult time spending the money during that 8 weeks because they had been shut down. So a 24-week period might be more beneficial. Others had been planning for the 8 weeks and have really been moving a lot of cost into that 8 weeks. They may want to cut it off at that 8 weeks and not run the risk of having potential reductions in FTEs or compensation later that would give them reductions. So you've got that option for the covered period. Alternative payroll covered period then is another option that you have just for the payroll and payroll related cost. And this is something that if you are a bi-weekly, if you have a bi-weekly payroll period or a weekly payroll period, so bi-weekly or more frequent, you are eligible to select this alternative payroll covered period. If you're an employer that has a semi-monthly or some other payroll frequency that is something more than bi-weekly, alternative payroll covered period, unfortunately, is not an option for you. But assuming that you are weekly or bi-weekly, you can look at this alternative payroll covered period. What that is it allows you to shift that covered period a little bit so that it can line up with your payroll periods. So it makes it easier from an administrative standpoint to pull the reports that you need to fill in the application for forgiveness. You don't have to do quite as much prorating of pay periods and things of that nature. So this alternative payroll covered period would say, begin your covered period for payroll cost on the first day of the first payroll after you receive your loan funds. So you get your loan, then you move out the first day of that next payroll period. That's when you would start this alternative payroll covered period. And then again, it would go out for that 8 weeks or that 24 weeks, whichever you choose. If you are somebody that gets the loan after 6/5, you are defaulted into the 24-week. You do not have an option to go back to the 8-week covered period. Additional items here on payroll. So there is a $100,000 annualized limit per person. So just like on the front end, when you applied for the PPP loan, the dollar amount that was used as payroll to determine the loan amount you were eligible for also had the same $100,000 annual limit per employee. On this back end here, when you do forgiveness, same thing, you're going to be capped out at whatever that $100,000 limit would be. So if you are using a 24-week covered period, that amount for payroll that you can include is $46,154 per person. So payroll is calculated off of gross pay. So those gross wages that you're paying to your employees. On top of that, you're going to add any company paid health insurance, company retirement contributions, as well as state unemployment taxes. Now, unfortunately, they've taken a pretty hard line here on these benefits pieces, the health insurance, retirement, et cetera, that these are employee benefits. And if you are an owner, you don't count as part of the employee's cost to be included here. So any of these benefit amounts, you don't get to include those for the owners. You do get to include the W-2 gross wages, but you don't get to include those benefit amounts for those folks. All right, so that's payroll. And then if we shift down to the eligible non-payroll cost. So the eligible non-payroll cost, this is just the covered period. So no option here to use an alternative period. So covered period, again, beginning the day you receive your loan funds, going out either the 8 or 24 weeks, depending on what you're eligible for and what you choose. Mortgage interest and real and personal property is included as an eligible non-payroll cost. Also rent on real and personal property, and then utilities. One item of note is that all of these must have had their agreements in place prior to 2/15/2020. So February 15th is kind of the line they've drawn in the sand as the date to determine pre-COVID versus post-COVID. So if we go back to the purpose, what they were trying to accomplish with this program, it's really, let's try to get money in companies' hands to allow them to continue to operate as close to normal as possible and pay their employees. So we've hit on the paying employees piece, but this other component of let's allow companies to continue to operate as they were before means that we're only going to fund things that were in place pre-COVID. We're not going to provide funding for any sort of expansion or investment in new equipment or new building, anything like that. So that's the purpose of that 215 date, is got to be something that was part of ongoing operations pre-COVID. All right, so that's our payroll and eligible non-payroll that get us the total eligible costs for forgiveness. Let's talk a little bit more about some of these reductions then. So wage reduction, if you have reduced wages for any individual greater than 25%, you're going to be looking at a potential reduction to your forgiveness amount. So any reductions less than or equal to 25%, okay, it is still going to impact those dollars, those payroll dollars in step one, but you're not going to get an additional reduction because of this wage reduction component here. Once you get that, or once you exceed that 25% mark though, now you are going to be looking at reducing the amount of forgiveness on a proportional basis. Now you can exclude anybody, any employees from this calculation that made over $100,000 in 2019. And the way that you look at this, it isn't maybe what you think, where you think, okay, let's go look at the W-2 wages for 2019, exclude anybody under 100,000 or over 100,000, excuse me. Instead, the rules are such that you're going to look at the individual pay periods in 2019. And if in any individual pay period for 2019, you annualize that out and exceeds $100,000, you're able to exclude that employee from this reduction calculation. So if you had somebody that for the full year earned less than $100,000, but they had a bonus in a particular pay period, if you take that bonus pay period, annualize that, and it's over $100,000, exclude them from this calculation. Now, it's important to note when we talk about excluding these folks, we're talking about excluding them from this reduction component. We're not talking about excluding them from the payroll dollars in step one. You'll still keep everybody in that payroll dollar portion in step one. Just when you move down to looking at these reductions, there's a little bit of flexibility here as far as throw some of the folks out. If you did have some reductions, it's going to lessen that reduction that you otherwise would have. The last item on here relates to the safe harbor for wage reductions, and Michelle touched on this. This was also one of the changes. But if you had a compensation reduction that took place between 215 and 426, you have until December 31st of this year to restore that compensation level back up to where it was as of 215 and not take a reduction. So it kind of allows you to have that dip between February and April and then get it back up to where it was by the end of the year, and you do not have any sort of penalty for reducing those wages. All right, then we move into the FTE reduction. So FTE stands for full-time equivalent, and this is based off of a 40-hour work week. So any employee that on average works 40 hours per week or more is going to count as one FTE. So you don't get extra credit for having people work overtime. You're capped out at one per person. If you have folks then that are working less than 40 hours per week on average, they're going to be something less than one FTE. So take the average hours that they're working, divided by 40. That's going to give you the proportionate full-time equivalent for those individuals. So you're going to look at your FTEs during the covered period, compare them back to a base period. We've got a couple of different options there as far as the base period that you can use. So definitely go through, look at those options, choose the one that is most beneficial for you. Jessica at the beginning mentioned that we do have a calculator, and we'll talk a little bit more about that, I think in a few slides here. But if you haven't started using a calculator to go through this, we highly, highly recommend it. Ours is very robust, so if you get it, you open it up, it looks like kind of a beast. It is kind of a beast. That's because the way that this application is and all the different time periods that you need to compare for, it's all in there. So you plug the information in, and the calculator actually will go through and select for you which is the most beneficial period to use. There's some other places where you've got options, again, using the alternative covered period or covered period, 8 weeks, 24 weeks. All that is built into our calculator that you can kind of switch back and forth between these different options and see which is going to give you the best answer. So go through, look at where your FTEs are during the covered period compared to that base period that you choose. And if you have any reduction at all, you're going to be looking at a proportional reduction to your forgiveness. So if you've reduced FTEs by 25%, that means that that forgiveness amount that you calculated there in step 1, that's going to be reduced by 25%. Last item on here, again, is that same safe harbor that we saw on the wage reduction piece. So if your FTE reduction was between 215 and 426, you've got until the end of the year to restore those FTEs. And if you do restore those FTEs, then no reduction. So again, allows you to have that dip early on, bring those employees all back by the end of the year, and you fall into that safe harbor. Unfortunately, if you kept your FTEs up during 215 to 426, but your covered period is later and you had a dip there, under the current guidelines for these safe harbor, you're not eligible for that. So potentially that's one of the areas that they could relax a little bit with some future guidance. Just keep a watch out for that. All right, so that covers all of the basics of how the calculation works. I'm going to turn it over now to Mike to talk about some best practices.
Thank you, Kate. Thank you very much. Yeah, so what we're going to talk about now is kind of some strategies to try and maximize the loan forgiveness. Originally, when it was 2.5 months times our average monthly payroll, and then we had 8 weeks forgiveness, essentially we're comparing 2.5 months compared to 2 months, right? So there were certainly a lot of circumstances where the forgiveness amount was coming up very close, even including some of the other 3 categories, the interest, the rent, and the utilities. Now that it's relaxed to 24 weeks, I think it's going to be a bit of a, I guess, a tale of two cities, as far as a lot of companies have come back to some degree of operations. And so they got 2.5 months times payroll. And within the 24-week period of time, probably gonna be pretty easy to pay or to consume all of the PPP funds and get 100% of it forgiven. Certainly just dependent upon where you are within the nation and what industry you are, right? That whole story can be the exact opposite. Certain industries, certain locations, just folks haven't been able to open up. So even under this expanded 24-week period of time, it might be somewhat difficult to spend all the money in an appropriate fashion to get ourselves in a position to get 100% forgiveness on the PPP loan. So really just wanted to walk through kind of some strategies that the whole intention here is, if we're not quite getting there, what might we be able to do with some good business sense to increase what's going to get forgiven. So the first item we want to talk about here is the eligible payroll expenses. And really this kind of gets to a bit of a cash versus an accrual concept. And so I think as accountants, a lot of times we'll run right to, well, help me understand, is this a cash basis kind of calculation? Is this an accrual basis calculation? And essentially the answer is, it is both. Best way to think about it is during the 24 weeks, or to the point made earlier, if it's better for your calculation and you don't want to go to the 24 weeks, you can still file all your paperwork within the 8 weeks. So these kind of ideas still pertain back to the 8 weeks. So if within your covered period, you basically say, okay, I've got 2 buckets of costs. I've got all the cost that I actually pay for. I make the cash distribution. during the 24 weeks, but then I also get to include items that I incurred during the 24 weeks, but I didn't necessarily pay within the 24 weeks. So let me kind of round that out just a little bit because there's a couple of nuances here. If you had items that were maybe some bonuses from prior periods, maybe a commission payment from a period of time outside of your covered period, and the actual cash disbursement was during that covered period, the interpretation of the rules is to say it was paid during your 24 weeks, so you get to count it. It's not a incurred and paid during the 24 weeks. It's essentially two different buckets. So it was paid during the 24 weeks, so you get to count it. Then on the back end, if we think about, okay, so at the end, maybe our 24 weeks ends on a Tuesday, but our payroll goes out to that following Friday. So let's say there's 7 days left that were actually incurred in our 24 weeks. There was a bit of an additional stipulation on the incurred but not paid. It's not incurred but not paid and just open at that. It's incurred but not paid as long as it's paid in the next normal payroll cycle. So our 24 weeks ends on Tuesday. Our next payroll cycle ends on Friday and actually is dispersed on Saturday. As long as those funds are dispersed on Sunday, then we are on Sunday, then we get to include through Tuesday kind of in that accrual concept. So items pouring from future periods into the 24 weeks really as a pure cash basis, but then there's this the accrual caveat on the back end of that payroll period. So bonuses and hazard pay. There was some concern early on that there'd be kind of rules comparing compensation during the covered period to prior periods and kind of preventing us from paying employees extra. It's been very clear in both the interim final rules and in the FAQs that not only is the kind of paying people extra permitted, it's almost encouraged, right? It is really the intent of the PPP loan program is to get money out into people's hands. So if we are giving people bonuses during the 24 weeks, if we're giving them hazard pay during the 24 weeks, that will count for their forgiveness. An item to always keep in mind, however, is this $46,154, that $100,000 annualized limit. You always have to keep that in mind. So if we have additional bonuses, additional hazard pay, but that person was making $90,000 a year already, then we just got to be careful. I mean, certainly you're allowed to use the funds on amounts that go over $100,000. It just simply will be excluded from the forgiveness. And I'm certain that all of our intention here is really to maximize the forgiveness and really get as close to, if not get 100% of the loan forgiven. Another item here, profit sharing contributions. This one actually has a little bit of an added benefit. The $100,000 relates to cash compensation. So if we have a profit sharing contribution, and let's say that we have a 2019 profit sharing plan that just because of everything going on, we just haven't funded yet, and it goes into a qualified plan, then you could fund that profit sharing contribution during the 24 weeks and actually include all of it really without regard to the $100,000, because the $100,000 gets after the cash compensation. Then on top of that $100,000, we're allowed to have what we're paying for healthcare, what we're paying for employee benefits, and then what we're paying for any state and local based taxes that are income based, right? So the typical example there is a state unemployment. But as long as this profit sharing contribution is going into a qualified plan, then it's really not subject to the $100,000 cap. Now, a overarching caveat we've already mentioned here, but just to really stress this, that the rules are specifically worded to prevent the owners from being able to have it be too rich for them and get too many benefits. So the $100,000 limit appears to be a pretty hard and fast an owner of a business, and they're really being very, very general here. It doesn't matter if it's a partnership, if it's an S corp, if it's just a Schedule C on your personal tax return. Any and all owners fall under this category. It's a very, very general definition that their amount in the PPP loan forgiveness is really capped off at the lesser of two items. One, $100,000. So if it's 24 weeks, it's at 46,154, or what their 2019 compensation was. So you might not even get the 46,154 if you didn't make $100,000 for the calendar year 2019. So all these items, as far as going above the 100 or up to the 100, really apply to all the employees. There are significant limitations as it relates to the owners. So if we shift gears here a little bit away from just the payroll cost, there's just a difference in how they've written the rules related to rent versus interest. So rent, there is no prohibition against prepaying rent. Kate had mentioned earlier that we're anticipating continual updates as this whole program goes. I wouldn't be surprised if before we get to the end, they kind of have some sort of FAQ that comes out and prevents prepaying rent. But for whatever reason, right, they went through writing the application and specifically said no prepayment of interest. And it can't be just a mistake, or at least you wouldn't think it is. They do not make that same statement as it relates to the rent. So if you think about going to a landlord pre-COVID, or not pre-COVID, but pre your covered period, and saying, hey, I just don't know where this is going, I need to pause on my rent, and you have some back rent that you haven't paid, and you pay this kind of catch-up rent within the 24 weeks, in addition to prepaying rent. As long as that rent agreement was in place as of February 15th, 2020, it's our interpretation that that's going to be included for the forgiveness calculation. As I've already said, the prepayment of interest, that is something that is specifically called out that you're not allowed to prepay interest. If you weren't paying the bank interest beforehand and you kind of have some catch-up payments, don't really see where there's any prohibition against catch-up payments on interest. One item of note, and we're not 100% certain where this is going, it literally just came out last night, but there was an interim final rule published last night that the verbiage in it says interest on any other obligations. It's kind of confusing to us as far as kind of I'm not sure whether it's intentional or not, but just reading those words at face value, they change a bit of a direction in the sense that prior language was mortgage interest on real and personal property. So it's a bit confusing to begin with to say mortgage interest on personal property, but we just got to whatever, right? It's so real and personal property. So clearly the interest on our mortgage counted. And then because they put personal property, clearly if we have a bunch of semi-trucks, if we have a bunch of manufacturing equipment, right? So the loans on that personal property definitely count. There was a bit of a unknown as it related to something such as a line of credit, right? So if we have a line of credit that is guaranteed by both inventory and accounts receivable, well, you're kind of left to wonder a little bit because the inventory clearly would be considered personal property, but the accounts receivable would not be considered personal property. So potentially they're just trying to clear that up. But they did come out in the interim final rule last night that all interest, prior to last night, we were thinking it was just mortgages and then equipment leases. So at any rate, just they're not leases, but interest payments. So just something to keep in mind. It does say now interest on all debt obligations. We just want to kind of call everybody's attention as we're really digging deep into the details and calculating out the numbers. Really just go ahead and try and save as much documentation as you can throughout that process. The application that the SBA currently has online, it's 11 pages long. It has not been updated for the 60%, and it has not been updated for the 24 weeks. But page 10 out of 11 does give a full page of all the documentation that the bank is going to be looking for. So really just makes sense that while you're going through all these calculations, just really kind of pull that documentation, save that to the side. It's really going to help you out as we're trying to think about kind of what might you need that for. There's two areas that we think you might need it for. One certainly is the SBA audit. If you got more than $2 million in the PPP fund, we're being told that it is going to be a mandatory audit. So if you got over $2 million, the information is going to be looked at. That's not to say if you got less than $2 million, though, it's not going to be looked at. It's just simply if you got less than $2 million, you're in a pool for random audit, versus if you got more than $2 million, it's going to be a mandatory audit. So clearly the SBA could be looking at it. Where we think that there's more relevance to kind of just making sure you're extremely thorough with the documentation is really for the banks. I think the banks, I mean, per the legislation, the banks are really supposed to be in kind of this held harmless role, that if the folks that are requesting the loan make bad representations, give bad information, and that's passed on to the SBA and there's a forgiveness, really the banks are supposed to be held harmless. But I know most of the bankers that I've been talking to, they're really not sleeping good at night with that, right? They're really not resting back on that to say, oh, great, we can kind of do anything we want. We're just not going to be held harmless. So we're really anticipating that when you give this information over the banker, that it's going to be maybe a little bit more thorough than what you're used to. A little more questions, really requesting a lot more documentation. So as you're going through and really trying to maximize items, you just might as well save all that documentation as you're going through it. So just to kind of bring everybody's attention to a couple of tax considerations specific to the PPP loan. Expenses included in the forgiveness calculation are not tax deductible. This is a change from what we believe Congress had intended. What it is saying is that if we get $100,000 of PPP loan, and we get $100,000 of that PPP loan forgiven, under normal circumstances, that forgiveness would be taxable income. So the CARES Act, the actual law, states that that forgiveness of debt will not be taxable income, but it was silent as to the expenses. So after the law was written, SBA and Treasury came out with their guidance, and they're basically saying that, okay, great, the loan forgiveness is not taxable income, but we're not going to allow the deduction for those items that the loan was used on. So let's just say we have a $100,000 loan, $100,000 was forgiven, we used all $100,000 on payroll, then we are going to need to reduce our payroll expense on our 2020 tax return based upon the amount of payroll expense that was forgiven. We don't believe this was the original intent in the law. In fact, you kind of almost can logically get there, I guess pretty certainly, to say if you have $100,000 of income and $100,000 of deductions, the net is zero. The way that the Treasury has done this, now the net is still the same amount, right? It's still just a net of zero. We don't get the forgiveness of that income, but we don't get the deduction either. So if the intention was just to have a net of zero, then Congress didn't need to do anything to begin with. We've already mentioned here, just really want to call everybody's attention to this deferral of employer social security taxes. It was originally thought to say, hey, you can't do both. You can't do the deferral of the employer social security and the PPP loan. Then they came through and said, well, you really haven't done the PPP loan until it's been forgiven. So you get to defer the taxes up until you hear that your loan's been forgiven. Well, they've actually taken all that away now in the Flexibility Act, in the sense that you can have the PPP loan, have it forgiven, everything, and defer your employer's portion of the Social Security taxes all the way until 12/31/2020, and then pay half of that 12/31/2021 and half of that 12/31/2022. Employee retention credit. This is something that is mutually exclusive of the PPP loan. Just kind of throwing this in there, if there are folks that have not gotten the PPP loan, are just too big to get the PPP loan, just make sure you're really taking a deep look at the employee retention credit and trying to maximize what you might be able to get for that employee retention credit. A lot of nuances to it, a lot of different calculations. The most benefit that you can get is $5,000 per employee, and that's not $5,000 per quarter per employee. That is a straight up $5,000 between now and 12/31/2020 per employee is the maximum benefit on that. Yeah, go ahead. What should I do next? So as Kate had mentioned, we do have a forgiveness calculator out there. I highly encourage everybody get their hands on a calculator and model out what you think your forgiveness is going to be. There are so many different nuances. There are so many different dates involved in the different reduction. There's just so many different nuances in the calculation that to try and go through the instructions and replicate what we've tried to do in this calculator, it's just going to take a lot of time. And so go and grab a calculator, grab ours, walk through it. As Kate said, it's just going to be a beast, right? When you open it up, but just don't let that scare you. because we got to work through all the details anyways. It's really going to help you keep track of the different elections, or not elections, because they're not any formal elections as part of this, but I guess the different choices that you get to make as you go through the calculation. And really, if you come up with something less than 100% forgiveness, it's going to be your tool to essentially reverse engineer where those reductions are coming from. And so if it's a wage reduction, if it's an FTE reduction, well, then we can really start honing in on the safe harbor test and make sure we get there. If it's just simply a spend, right, we're just not spending enough on the PPP loan, then we can kind of reverse engineer that and say, are there some good business expenditures that we can do during the 24 weeks to try and increase the amount that we're spending? We always want to kind of make sure to emphasize that if we are spending good money, right, it has good business purpose, then absolutely we want to get as much into the 24 weeks as period, into the 24-week period as possible to maximize the forgiveness. I would not suggest spending money that just isn't smart for the business to spend. I would not, if we've already given somebody a $500 bonus to get them to come back to work, we're just going to give them another $500 bonus to just simply use up the PPP funds. That might not be a great move. If we are going to get just double the goodwill out of the employee, well, then maybe spending that additional $500 will work. But if we've already gotten the goodwill from the employee, then a 1% 5-year loan, keeping that $500 in our pockets for a rainy day over the next 5 years is probably a better business decision than simply just trying to spend it for purposes of getting it, I guess, forgiven. So a couple of other things I did want to kind of point out to everybody that's not necessarily on the slide, but it is out of the kind of just the interim final rule last night. Then just also just a, I guess another thought is there's a 10-month rule now that from the point of your covered period ending, you have 10 months to submit your paperwork to the bank and come back. Then the SBA has 90 days from the point that the bank submits it to I guess, come back. So if we go back to the previous slide and say, okay, well, I don't get the tax deduction for the amount that was forgiven, a lot of companies are very likely going to be in the situation where come January, February of 2021, we'd like to be doing our tax return. We'd like to be calculating what our first quarter estimates need to be. We might not know what our December 31st, 2020 tax return looks like yet because we haven't heard back from the SBA of what our forgiveness is. So just FYI, we're trying to kind of keep track of that to figure out how that's exactly going to work. But right now, that's a pretty big question mark. Second item is just to note there are still funds available. I believe certainly everybody that we consult with and whatnot, right, we've tried to do everything we can to maximize it. This is more a comment for kind of friends and family. There are, at least my experience has been, a tremendous amount of just sole proprietor Schedule C taxpayers out there who really just they just don't understand how this program works. And they really don't understand that a simple call to their banker and a little bit of time on their end, based upon their 2019 Schedule C income, if they had like $40,000 on their Schedule C in 2019, by picking up the phone and calling the bank, they could likely just have $8,000 of free money. If they happen to have $80,000 on their 2019 Schedule C, then that number doubles. It's literally $16,667 that they would be able to potentially get a PPP loan for, pay themselves that same amount and get it forgiven. So this Paycheck Protection Program, while it's punitive to the owners as far as the healthcare and whatnot going above the $100,000, it is not meant to be punitive to owners just because they don't get a paycheck in a traditional sense. If you're a partner and just get a K-1, if you're a sole proprietor and you really don't get a paycheck, it's just on Schedule C, all of that self-employed income from 19 essentially counts as if it were a paycheck. So for purposes kind of friends and family, just if you're conversing with them, remind them there still are funds available if they haven't done something. If they want to, we'll be happy to help them through that process. And I think now I'll hand it over to Jessica and we'll go over some questions.
Okay, great. Thank you so much. So I know that some of these topics you may have touched on already, but I'm going to go ahead and ask the panelists to go ahead and unmute their mics, and then we'll go into the questions. So the first one I have is, if you are an employee but also a shareholder of a privately held company, do you still have to exclude their retirement and health insurance benefits?
Yes, if you're an owner in any way, shape, or form, you don't get to bifurcate the portion of your services that's an employee versus what is a owner. If you're an owner, then you are not allowed to include the health care or the retirement benefits.
And no threshold to that. It's
unfortunately not.
1%
0.01.
owner, you're out.
Okay, great. Kate, you mentioned you anticipate more changes to come. Directionally, what are some of the more significant changes that you believe may be in the pipeline?
Yeah, I think the biggest ones that we thought might be coming did happen with that Flexibility Act. Some other things that are potentially out there, I'd say generally speaking, I think the direction of any changes would be to allow for more flexibility, making it easier for businesses to obtain forgiveness. Some potential things could be that issue of taxability. That was an item that seemed to get a little more attention earlier on. I haven't been hearing as much about it lately, but potentially we could see some legislation come out that would kind of reverse what the IRS's ruling was on that and allow for deductibility of those expenses so that you don't have that kind of net zero impact that we were talking about, but you actually get some benefit there. I mentioned with the safe harbor that there's that kind of February 15th through April 26th period that you could have the dip and then bring that back up for FTEs or wage reductions by the end of the year to obtain that safe harbor. Potentially, we could see some movement with expanding that 215 to 426 time period to allow for those reductions to happen in a broader period of time and making it easier to meet that safe harbor. We have also heard some talk about that deferral of Social Security taxes for the employer portion, that right now, everything that you defer between now and the end of the year is going to be due 50% by 12/31/21 and then 50% by 12/31/22. We've heard some talk that potentially they could actually just make that like a grant. You don't have to pay that back, so a permanent deferral. And I've also seen some talk about maybe a second PPP type program that would be very industry specific. So think about the industries that are getting hit hardest: hospitality, restaurants, things of that nature. Potentially, we could see a second program that's more specific to those industries that were hit early, hit hard, and are still continuing to have a lot of negative impacts. Their ramp up period is going to be much slower just due to the nature of where they are. Going the other direction, they could come out and say, hey, no prepaid rent. Mike mentioned that as something that might be a negative to us. Potentially they could also say, hey, those profit sharing contributions that you guys are all making during this covered period to increase the dollar amount, we're going to make you prorate that. So if you're making a full year's worth during the period, we're only going to allow you to count 24 weeks worth of those costs. I think those are some of the things that are out there. We're also hoping just for a little bit more clarification in certain areas about what counts as utilities, for example, some things like that, but all much more minor in nature, and I'd say generally speaking, making it easier for companies to obtain forgiveness. Hopefully this new application also just makes it easier to fill out the application. It's very complicated, as we've said, and if the whole goal is just to get money in people's hands and to make it forgivable, boy, they've made it really hard to get there, right? And making it just jump through a ton of hoops. So hopefully we see some some relief there as far as the documentation and the number of time periods and such.
Hey, Kate, I have something else to say. Specific to the tax deductibility, where she mentioned that hopefully maybe we'll get some movement or some congressional action to allow the deduction. In the very least, if we don't get that, I would hope there is some kind of guidance specific to the timing, because if we don't know if our loan is going to be forgiven until way out into 2021, we won't know what to do with the 2020 filing. So I'm hoping at the very least we're getting some guidance on what to do with the filings for 2020.
Those are all good insights. Thanks, guys. Someone just wrote in and said, can someone bring up, give some insight into what makes you eligible for the PPP loan? It says you must show that the company is hurt financially by COVID. Are there other sort of eligibility standards that you have to have?
Yeah, so what they've drawn the line in the sand at a $2 million loan. And essentially what SBA and Treasury in an FAQ has come out and said is that if you receive less than $2 million, then the presumption is you're a smaller organization. You do not have hundreds of thousands, millions of dollars of reserves. And so just the simple uncertainty of the future allows you to certify and allows you to qualify. All the press that was on you almost have to be illiquid and need the funds, that died away. There still is a very big question mark out there, however, if you're an organization that your PPP loan is more than $2 million, the press, everything kind of died away from it, but there really has not been great guidance as relates to why are you eligible. So kind of if we kind of segment out the question, under 2 million, you're really good, right? You're just presumed to need it because of uncertainty. More than 2 million, we've been advising folks that looking at reduction in sales year over year, quarter over quarter, looking at reduction in profitability, looking at reduction in productivity if folks weren't able to come to work or maybe had a social distance them. We have not seen in the private companies where it's going to the financial wherewithal of the owner. It does still seem to be focused in on the financial performance of the entity filing for the PPP loan. Certainly Munchin has made comments as it relates to the public company world that does seem to kind of transcend through the entity itself and get after access to funds. That if they're publicly traded and have access to a lot of funds, kind of presumably they really wouldn't qualify for this PPP. So there's just all kinds of different nuances in that answer. More than $2 million, I'd focus in on the entity and show where COVID-19 had an impact. If I were in your shoes, that'd make me feel a lot better. And if you're under $2 million, then you don't have to worry about it. You're just presumed to be worthy because of the uncertainty.
Just to add to that a little bit, you know, for the over $2 million loan amount, so there's this idea of need, but there's also this idea of uncertainty. And so depending on the business that you're in, there are some that maybe didn't have that large of an impact or any impact up front, but there was certainly a lot of uncertainty about what it was going to do on a lag basis. So if you're not seeing any, you know, impact up front, but you've got, you know, documentation that you can show that you had uncertainty that, you know, on a lagged basis, you'd have negative business impacts. You might have, you know, an argument there. The worst that can happen if you apply for a PPP loan, get that loan, and then it's later determined that you did not meet that necessity requirement, is that you're obligated to pay it back. So there's no penalties on top of it, unless it's just a fraudulent application. We're not talking about that. We're talking about somebody that submitted in good faith, right? So penalty is, hey, you pay it back, but there isn't anything on top of that. So risk is fairly low. For a while, I also thought, well, hey, there could be some reputational risk. So if there's a list of PPP loan recipients that gets made public, and potentially there's just some negative you know, press and things around that, and you might suffer some reputational risk. The most recent comments from Treasury Secretary Mnuchin are that he's not going to be making that public. So the risk of just kind of reputation and that getting out is also reduced.
Alrighty, so we have one final question, and we'll go ahead and take that question and then we'll end it. Does the Flexibility Act signed 6.5 apply to the loan funds prior to 6.5, which I think you guys touched on a little bit, but just to clarify.
Yeah, it does.
It does. There is a nuance there, though. We're told that the 2-year to 5-year term is not an automatic, that you need to go to the bank and request the 5-year term. So I think there are some kind of tactical operational nuances to that. But holistically, yes, the Flexibility Act pertains to all loans that are in existence. But like I said, you need to go back to the bank and ask for the 5-year term. It's an automatic change.
Well, thank you, you guys. I'd like to thank everyone who attended. I'd like to also reiterate that we will be sending out a recording of our webinar, and we have directed you a little bit, if you see down the chat feature, to the calculator, but we will also be sending that out as well. I'd really like to give a big thank you to FEI and to Jolene for having us, and thank you to our panelists. Again, we'd love to hear you guys, see you guys again at one of our sessions. But thank you for joining us and have a good rest of your day.
Thank
Thank you, everybody.